Well, good morning, everyone, and welcome to another in our series of Tax 101 Andersen webinars. Today's topic is state taxation in both the US and Canada. And I've got a special guest with me today from the Andersen US office, the National Tax Office in San Francisco. I got Eric Andersen. Good morning, Eric.
Good morning, Stephen. Thanks for having me.
Hey, very happy to have you, Eric, here. I think many of you know that before we joined Andersen, we were WL Duke & Co. And we've actually been with Andersen 5 years now. We celebrated that in May. And years before that, when we first started entertaining the idea of joining Andersen, my partner Warren Duke and I, we traveled to San Francisco and we met the office there. And the first evening we were there, we had dinner with a bunch of colleagues, including Eric. And I got to know Eric and I got to know his practice and got to understand that Eric actually has a lot of connections to the Pacific Northwest. He is a proud graduate of the University of Washington, and he'll tell you all about his favorite football team, the Huskies, if you ask him.
I most certainly will. And, Stephen, you're right. I have a great affinity for Canada. I think my favorite city, notwithstanding being from Seattle and living in San Francisco, my favorite city on the West Coast is Vancouver. I spent my honeymoon in Nova Scotia, around Cape Breton Island and other places. Some of my best friends are from Alberta. So lots of connections to Canada. I'm really, really thrilled that you all joined our firm, and now that we can do this here today and we can address your audience.
Well, thank you very much, Eric. No, we're happy to have you here. We'll spend probably we're going to go through all the different U.S. Canadian tax issues as it relates to state taxation. Just a little bit of housekeeping as we go through this. These webinars are now certified for the National Association of State Boards of Accountancies, and so you can get your CPE credits if you participate here. You've got to do a couple of things to get your credit. We have 3 different polling questions that we'll put throughout the platform, so we ask you to vote on those. You need to stay for the full 50 minutes, and then some point over the next kind of 24 or 48 hours, we'll send you an email with your certificate. So we're happy to do that. We know you have questions, and we always allow time for our team to go through the questions, to ask the panelists. And so please type them in the corner there as you see it. There should be a chat box. You can put them in, and we'll make sure we answer as many as we can. There is a live transcript. If you click on the CC button, you should be able to hear or at least see the transcript of what we're saying today on a pretty rapid and pretty accurate method. And we always ask you after this that we'll send out a survey. We determine and populate a lot of these topics based on the feedback from our listeners and from our viewers. So please let us know what future topics you'd like to hear. You never know, we may be able to do one shortly, or at least as we look to 2024, we'd be happy to do that. So without further ado, this is some of the things we'll talk about today, a little bit of our agenda. We'll talk kind of some of the basics as it's a Tax 101 on what is state tax nexus and what does it mean? How does it relate to Canada when it comes to the income tax treaty and other types of treaties? We'll talk a bit about kind of sources of income and what does that mean and how do we determine what that means for state taxation. We've got some specific situations and examples we'll share, and Eric's going to promise me he's going to share one of my absolute favorite stories of a situation they do in California. So you got to stay tuned for that. That is worth the price of admission here. So, Eric, I'm going to turn it over to you, and how about you get us started here?
Yeah, that's great, Stephen, and thanks for that introduction. That we wanted to start just with an orientation and a map because, Americans are famously terrible at geography, even our own geography. But this is the map of U.S., Canada, and the rest of North America and Central America, and you can see all of the different states of the United States. But what you don't see is all of the taxing jurisdictions within the United States. So what I do is everything subnational. It is not federal income tax or anything at the national level. It is everything below that. There are more than 50,000 taxing jurisdictions in the United States. So what you see here are the states, but you don't see the cities, the counties, the parishes, the multi-county jurisdictions that deal with transportation taxes and other things. So keep that in mind, that the subnational government of the U.S., just like Canada, has a lot of authority to impose different types of taxes. Well, what are those taxes? Well, the ones that we are commonly used to, like the income tax that hinges off of the federal income tax, but the states have their own spin on the way that they tax income, and we'll talk about that a bit today. Sales and use tax is very similar in a way to goods and services taxes or value-added tax imposed on the sale of generally tangible personal property, but other things as well. Property tax, which was the foundation of taxation in the United States. And then, as I mentioned, local taxes and miscellaneous things like extraction of natural resources and others. So a panoply of things that we could talk about. Today, we're going to do a 101 that explores some common principles across the tax areas and focus principally on the income and sales and use taxes because of those are the two that tend to hit individuals and businesses most particularly that are coming inbound from Canada. So let's get into some nexus developments and what state tax nexus means, and I'll say state and local tax nexus. This is a good comparison and contrast. I mean, the lens through which we look is colored by the geography from which we sit. So from the US perspective, we think about this term of nexus, and you might hear that bandied about of we may do a nexus study or we may do a nexus review. Well, what does nexus actually mean and what is it derived from? Well, the word nexus merely means a connection. That's all. But the word nexus is also born out of our federal law that imposes restrictions and limitations on what the states can and cannot tax. Nexus is actually born out of a principle in the US Constitution. And the US constitutional principle is related to some provisions that create that limitation that I'll talk about in a minute. But it's effectively a limitation on the authority to tax. It's derived from federal law, and it is a minimum connection to a state or local jurisdiction before a state or local jurisdiction can ask anything from you, whether that be an out-of-pocket income tax or a collection responsibility over a tax like a sales tax. Now, Stephen, that's not terribly different than Canada, but maybe there are some differences. Do you want to maybe explore some contrast with the Canadian provincial rules?
Well, I think it is, and my partner Warren always says, we have similarities between Canada and the United States, but it is the differences that are the important thing that set us apart. Canada may not use the term nexus as much. The concept is more doing business in, or what establishes a permanent establishment. I would call Canada a bit behind in the sense of taxation on an electronic commerce type basis between provinces. That concept that if you're going to be subject to income tax or any kind of state sales tax in Canada, it's generally beginning because you're physically doing business in that province, as opposed to across or with the province. Similar to the US, though, it is every jurisdiction is a bit different, and you have to look to provincial law. You have to look to the different cities that may have different types of whether it's sales taxes or vacancy taxes or other different types of levies. And you have to look at what is taxed. What is that concept? In general, for sales tax in Canada, goods are generally taxed, but in certain provinces, services can be taxed too. I think the other difference I see in Canada is most of the provinces have some sort of agreement, at least from an income tax perspective, that the federal government will enforce the law, will collect taxes, and so you're filing a combined federal and provincial income tax return. In contrast, in the US, it's the exact opposite. Every one of these taxing jurisdictions has, if it levies income tax, will have its own income tax regime, its own income tax forms, and it's a very different process to deal with state income tax as opposed to Canada, where it's generally combined.
Right. And I see that we had a question pop up, and we're going to get to that question in just a minute, and we'll address it in the slides. And so it relates to the reason that certain state jurisdictions don't recognize some of the restrictions that are based in federal law. So we'll get there. Continuing on with the nexus question before we get there, let's lay a foundation for what this really means from an international perspective and where we are. In international transaction. Well, first of all, let's go back. I think we went past one slide, Stu. Okay, no, I'm sorry. We were on the right slide. So
Okay.
in international transactions, so with Nexus rules, the question is whether or not the same standards apply to international transactions and domestic transactions. And the answer to that is, well, maybe there may or may not be a treaty protection, and we'll get to treaties in a minute, but generally the same standards apply to cross-border transactions between a state, like going from Washington State to Oregon to California, or going from British Columbia to Washington or British Columbia to Oregon. The same restrictions on what a state can and cannot tax do apply. And those restrictions may be very similar to what Steve was talking about in Canada, which is does a physical presence, is that necessary or not necessary in a state? We do have a case that came out in 2018 that was a lightning rod in the United States because there was a physical presence standard that tended to be the primary standard across the states for whether or not a state could impose a sales or use tax collection. And there was an open question about whether or not that standard applied to the income tax area as well. And in 2018, our Supreme Court answered that question and said, well, no, actually, there doesn't need to be a physical presence in the state. You do not need to have a human, you do not need to have property in a state in order for the state to impose a tax or a tax collection obligation for sales tax. Well, what does that mean from the standpoint of a cross-border transaction? That means that if you direct your economic activity into the United States, you derive income from a source in the US because you have a customer here. You ship property, tangible goods to an individual in the US or to a business in the US. That in and of itself can create a tax obligation. So we now have this open question of if you are doing business in the US, if you do have activity that crosses the border, and there is no physical presence, but maybe an economic presence, is there a tax that could apply? And the answer to that is yes. Now, there are certain limitations that can apply to that that are also based in federal law. One of them is Public Law 86272. So the standard of nexus is derived from the US Constitution. Our Congress has the authority to regulate commerce among the states of the United States and among countries. The states do not have that power. That is why we have a nexus restriction, that there has to be a connection between the activity and a state. A state can't tax anything that they want. And there are restrictions around that that are steeped in what that presence needs to be. Well, Public Law 86272 is a federal law that restricts the ability to impose an income tax on sellers of tangible goods if the only thing and only activity that is going on in the state is the solicitation for those tangible goods. So example, a company in Canada that sells nutritional products, let's say in the United States, which I had one of these operating out of Alberta, sells into the United States, ships the product into the United States. The states may be restricted under Public Law 86272 from imposing an income tax obligation. Now, the treaty may also create a restriction, but the states may or may not follow the treaty, but they have to follow the federal law.
Well, and I think that's a really important way you phrase that. And Eric emphasized the word may. The determination of how Public Law 86272, how Wayfair, how all the states would apply is always fact dependent, and it depends on the level of activity. It depends on the structure you have. It depends on not necessarily, the physical presence you have, as you can see with Wayfair, but it can depend on revenue. It can depend on which state you're doing business in. It's a whole host of factors. And I think it's really important to say that, these things can help us potentially avoid certain things, but you need to drive into the details to get that conclusion.
Right. And we'll hang here for one more minute because I'll make a contrast between individual and business activity as well. An individual is generally subject to a tax based upon where the individual physically does their work if you are an employee. So if you are an employee coming into the United States, there may be some protections and limitations on the level of that activity. But if you come into the United States and you're working in the US and you have a secondment relationship or you have a long enough period of time, the states may be able to impose a state income tax on that activity, like our federal government may be able to withhold on wages. But that's different than businesses. Businesses that direct their activity into the United States may merely need to have economic presence, meaning a customer in a state of the United States or a local jurisdiction, in order for that state or local jurisdiction to impose a tax. So there is still an overlay with physical presence for individuals, but on the business side, that physical presence now has been the restrictions have been lessened. So let's move on to what the different standards for state and local taxes are, because you actually do have to look on a state by state and jurisdiction by jurisdiction level. And Stephen mentioned that in Canada there are doing business standards in the provinces, and that is also true in the U.S. states. So while the U.S. states may have restrictions based in federal law on what they may or may not tax, they still need to have imposition statutes that confer the authority to impose a tax, which may be based on doing business, it may be still based upon physical presence, or it may be a very wide nexus standard that is to the fullest extent allowed by the United States Constitution. And that gets back to that decision that was rendered in Wayfair in 2018 that says you don't need a physical presence for a state to impose a sales tax collection obligation, but that case may be extended to other taxes like the imposition of an income tax or other types of taxes. So look at each state or local jurisdiction's imposition laws through the lens of they have to be restricted by federal law, but there may be greater restrictions because the imposition statute creates a greater restriction. Okay.
Excellent.
So let's talk about what do we do about it. So you have activity in the United States and you're thinking about the local jurisdictions. How do we address this, and what is the way to go about this? Well, you'll hear the term nexus study bandied about, and I think nexus study is a term that we use and that many practitioners use, just in terms of looking at what the connections are, aligning that with the laws in the local jurisdictions or the state jurisdictions. But I really think of this as a taxability assessment more than just a pure nexus study, because the real crux of the question is not just, do you have a connection, but what is that connection going to require you to do? Because that connection may create a responsibility like a sales tax collection that, if you don't do it, could create a personal obligation for the tax that was not collected by the non-collector. Or it could be merely a filing because there is no income or no item that could be sourced to the state or local jurisdiction. So it winds up being an administrative matter. So in looking at taxability assessments, you start with, what is the nexus creating activity? What type of an obligation does that create over the individual or the company? And then beyond that, what is the actual tax liability that results from that connection? And when we see that obligation could be significant, and I'll go back to the nutritional supplement company that I worked with in Alberta, we found that company, in crossing into the United States, was coming in and doing a lot of activity in a variety of areas. They were going to fitness competitions and bodybuilding shows and selling their product real time, or directing people to the website, shipping it out of Canada into the US, and not collecting sales taxes in all of the US states. Well, that creates a liability for the uncollected tax everywhere, and that obligation could be quite significant. So what do we do about those situations? You can go in and you can negotiate voluntary disclosures with the states to absolve penalties, sometimes interest, sometimes the period with which that you would have to comply with the taxes. And those are very typical situations that we see coming in from Canada, is to go to the states or local jurisdictions and make your comeuppance and get a deal. So that you can bring yourself into compliance.
Well, and I think, Eric, you'll talk a bit about that later, but that activity of looking at what you've done in the United States, the various state taxation, it can be a really important issue when you go to sell your business. The buyer of the business, as they conduct their due diligence, those are the kind of questions they're going to be asking is what, if any, state income tax or state sales tax exposure do we have by buying this business or buying these assets? And, you know, the work you do now is going to really help that sale. In contrast, ignorance of the rules or just non-compliance or just not doing anything about it is going to really be a problem when you try and close any kind of sale of your business.
Right. That's right. And that's where we really think about this as a taxability assessment, which is, are you taking on some kind of an obligation that or have you missed an obligation that relates back to the company, that when you do have an exit event, that is now going to be a successor liability to the buyer that the buyer does not want to inherit. And that is a big deal. You know, we see a lot with service businesses just because of the Nexus rules being so watered down for service businesses. That customers in the United States can create obligations for income tax. And then, of course, individuals working in the U.S., we certainly see withholding obligations at the state level that are required, and state filing obligations. So we really think about this as an approach to compliance. How do we actually get our businesses and our individuals into compliance with the state and local rules, and map out what that process is, and it does vary state by state.
Well, and it's one of those things that, you know, I often have clients ask me, especially in Canada, when they are selling online, or perhaps they're, you know, going to trade shows, or they're attending conferences, or they're actually making sales trips, and they say, well, how are they going to know? I mean, you know, we're not a U.S. business, we're not on their radar, we're not registered. How would they possibly know? And you know, I tell some interesting stories. I mean, in my former life, before I joined Warren, before we joined Andersen, I worked for an engineering firm, and we had a fairly big construction outfit in the United States, and we would do construction projects all over the U.S. And, you know, when you're doing these things, you're proud of what you're doing. And so, you know, we would put our logo and our name on the construction site, you know, proud partner of whatever it is. And in my first year when I was there, we got a random letter from a state government in the East. I want to say it was from Michigan, asking about Nexus. And in my early part of my career, I had no idea what they're talking about. I went to my CFO and I said, you know, what are we doing in Michigan? I mean, we're a Canadian company. And what we found out from the state auditor is they went and did a drive-by of the construction outfit and took a photo of every single sign, and went and did an internet search and just fired letters off. I mean, that's fascinating to hear that that's how they found. I mean, the solution there was, well, we were doing something, but it wasn't our Canadian company, it was our U.S. subsidiary, and so we were able to kind of, you know, handle that. But those are the kinds of things that can happen when you least expect it.
Right, exactly. So we had a couple of questions that I think we can address in this section, which is, you know, are there some minimum standards of Nexus and some rules of thumb that we can go about? And the short answer to that is, well, each state, each local jurisdiction is different. The broader answer to that is, if you look at what the Supreme Court case was in Wayfair, there was a standard that court was considering. The state of South Dakota had imposed a collection obligation for sales and use tax if an out-of-state business selling into South Dakota that had no other connection other than selling over the web, if they sold $100,000 of product or had 200 unique transactions to customers in the state. That was the standard. Now, our Supreme Court didn't say that is the standard, but they did say that is a standard that would pass muster under having a minimum connection to the state that would confer the state's authority to assert its jurisdiction. We don't know if that standard is the same for income tax, because no court has ever said so. But the states have created their own standards. For sales and use tax collection, most of the states have adhered to that 100,000 or 200 transaction with some modifications, but just about every state of the United States has adopted that standard. For income tax purposes, many of the states have only adopted to the extent the U.S. Constitution allows, and we do not know exactly what that standard is because that hasn't been decided. So, but I think that $100,000 of sales to customers in a state is a baseline and something that you might consider as a benchmark for thinking about when you have activity in the US, it would be enough.
Well,
Now,
I
for
think
a
it's really
service, yeah, I just really quick for a service
Go ahead.
business, you know, it's a little bit of a different equation because you could have a customer in a state for which you're providing a service, and then you have to marry that with what are the rules in the state for how services are actually sourced, and we'll talk about that in a minute. Sorry, Stephen, go ahead.
No, that's absolutely. I think what Eric's making a good point on, and I think it's worth repeating. For a Canadian individual, for Canadian business, for activity, one does not have to set foot in the United States or have salespeople or have a physical location to be subject to U.S. state and local taxes. And we see that often with people that either sell product on Amazon or they provide services, and they never leave their home office here, or they never leave their downtown Vancouver or Calgary center. And they tell us, well, we're not traveling to state X or whatever it is. And when you go through the economic, the click through, all these other different transactions, you still could be subject to state income tax and or state sales tax, depending on your activity, even though you never set foot in the state.
Right.
Absolutely.
So I have a polling question.
I believe we do, and we're at the point here as part of this to get CPE credits. We've got our first polling question. So it's multiple choice, and of the following four we've listed here, we want you to pick the most appropriate definition for the term nexus.
The most appropriate definition. So these are pretty good. Total revenue earned in the state, total payroll to state-based employees, level of connection between the taxing jurisdiction and your business activity, an auto dealership in Surrey, British Columbia. I think I need to go to that auto dealership in Surrey and see what it's all about.
Eric, they would take care of you. It's Nexus, I think it's Nexus Auto Group, and yes, I was doing a Google search on that, trying to think, okay, you got to always put something in there. So
that's fantastic. Well, I think one of the slides before we had a comic book character named Nexus. So let's see what people say. All right, so people are thinking about this, the level of connection between the taxing jurisdiction. So that's right. I think that's probably the most appropriate. What's interesting about that, some people put total revenue earned in the state, and I talked about the benchmark of a connection, which the Supreme Court talked about, which is the revenue earned in the state, or the customers, what you derive from the state. So I think that is probably the standard that most of the states would look to. But if you're thinking about just a general definition of nexus, it is the connection between the jurisdiction and the activity. And it could be business activity, it could be individual activity doing something in the state that relates to business, deriving income, property that you own. So C is probably the most appropriate.
Excellent. Thank you for that.
Yeah, like good perspective. So let's move on to tax treaties, because this is always a thorn in everybody's side. I'll say this just very briefly. Tax treaties do not necessarily apply at the state level, period. The states are not compelled to follow them. They are a province of federal law. Now, that seems really strange, because I talked about the U.S. Congress has the authority to regulate commerce between the states and between the foreign jurisdictions. But the federal government has given a pass to the states, saying that you don't actually have to follow what federal law says, that the states are allowed, with certain restrictions, to impose their taxes, so long as those taxes do not overstep the bounds of the federal government speaking with one voice with respect to foreign policy. And tax treaties are not necessarily foreign policy. That seems strange, but that is the way the rules are constructed. Well, many of the states actually do follow the tax treaties, but a lot of them do not. So I looked back at a survey of state tax administrators, which was conducted just last year. It was done by Bloomberg Tax. So they go to all the states and ask them a variety of questions. One of them is, do you follow tax treaties? And of the states that were asked that question, which was all of them, many of them declined to answer. But I wrote down here that of the states that did answer, only 4 said yes, that they blanket follow tax treaties. 20 said no, and the rest of them declined to answer. And most of the ones that declined to answer are the ones that pick and choose certain provisions that say, well, we'll follow this provision of the treaty, but not that provision of the treaty. Now, one part of this that I found quite interesting is, if you look at the states that were on the no list, let me read some of them off to you. Alaska, California, Minnesota, Montana, Maine, Do we see a pattern here? They are all the states that happen to border Canada. I don't know if that was intentional, but it is compelling to think that you have border states that are saying, no, no, we don't follow the treaties. And California not bordering Canada, but lots of transactions between California and Canada. So we see a mismatch between federal law and state law in many of those states. Do we have any influence over that? Well, that's a tough one. There are lobbying groups in the U.S. Council on State Taxation is one of them that I work with quite often. The Multi-State Tax Commission that tries to create some consistency in laws is another one. Multi-State Tax Commission is really more about consistency. Cost. The Council on State Taxation is more about trying to get effective tax policy, and cost does lobby to get treaties applied at the state level, and those lobbying efforts have been falling a lot on deaf ears in our Congress. So we don't have blanket rules for tax treaties. What does this mean? Well, the primary meaning for businesses is that permanent establishment is not a state tax concept. So you can have economic activity in a state without having an actual physical office in a state. And that may mean that you have an income tax obligation in a state where a federal U.S. income tax obligation is not applied because of the treaty protection at the federal level. Seems strange, but that is the rule.
Well, and I think that really catches a lot of Canadians who would assume or just take the perspective of, well, we've got an income tax treaty, and as you just said, that will help us potentially eliminate any federal taxation on whether we just either we don't have a permanent establishment or we meet other certain tests as individuals. And yes, we can be physically in or doing business in or with the United States. We may not be subject to federal income tax, but that doesn't mean anything for state income tax. And you picked on California there for a bit. We see this time and time again where we'll have Canadians that are doing business in California. They're employees that are working in California, and they may not be subject to federal tax, but they are subject to state income tax. And that doesn't change things overall for them. That California tax would still be what's called a foreign tax credit or creditable in Canada, but it involves a filing obligation, involves payments, and involves make a determination of how much of your employment income, for example, would be taxable in California. And it does catch people.
Right. Absolutely. And the treaties, that's it. You talked about it catching people. It catches people and businesses. So if we go forward and into individual and business activities, I'll just give you two examples of where this can really have an impact. So under the U.S.-Canada tax treaty, an individual that leaves Canada has an exit event and has an exit tax. So if you own a business in Canada, the business is worth a great amount of money. You expatriate from Canada to the United States under the U.S.-Canada tax treaty. You can elect to have your tax paid in Canada on the exit, and then your basis is stepped up in the business. So if the business is worth $5 million, your basis is $1 million. You can pay the tax on $4 million. When you come to the United States, your baseline is $5 million. Let's say the next year you sell it for $6 million. Well, now in the United States, you're taxed on the $1 million because you got that step up from having paid the Canadian tax. But guess what? If you come into California or you come into any of those other states that don't follow a tax treaty, your step up does not apply. So when you sell the business for $6 million, your basis is $1 million. California is now going to tax $5 million.
And that's an eye opener, and that's a great example, Eric. And it's something that is an issue, but it also creates an opportunity. And when we work with clients, when those types of scenarios happen, and we find out that in advance of when they're trying to relocate, example, pick on California again, we'll sit down and say, okay, before you move, here's what you're going to be facing when you have that exit. Here's the steps we should take, whether it's an investment account or a business or whatever it is, to do something to ensure that when you come to California, your cost basis is more appropriate to what it is going to be under federal tax law because as you said, we can't make this election for state income tax purposes in many jurisdictions. So you want to do some other planning or some other reorganization to try and get the same result.
Right.
Just got to look at it in advance. But you're right. It's a great example.
Right. Yeah, and then on the business side, I mean, I think we talked about permanent establishment, and I think that is the biggest issue is permanent establishment is actually a physical office, something concrete in the U.S. You don't necessarily need that on the on for a business to be subject to tax because you could have economic activity in the U.S. What does that mean? You know, the states. There is a safeguard, and it's also borne out of federal law that the states can only tax a proportionate share or an apportioned share or that share of the activity, whether that be a transaction or income in the state that is connected to that state. So there must be some apportionment of that income, and we're going to get into income sourcing rules in a minute. But that is a bit of a safeguard that the state can't tax everything. They can only tax that proportionate share of what you are doing in the state. Well, what is born out of that, and in some of the fights that businesses have had related to tax treaties and related to this lack of protection because of no permanent establishment, is some of the filing methodologies. And there was a question about, well, what is the water's edge filing methodology in California, and what is that all about? Well, part of that is because businesses are subject to tax in the U.S. on this proportionate share. Many of the states create a worldwide filing obligation. Not a lot, not many of them, but many do, including California, including Alaska, and now New Hampshire. One of your neighbors is looking at this right now to create a worldwide filing obligation. Well, what a business can do that is operating in a state of the United States, they can make a water's edge election in many of the states, California included, which means that you cut off the entities, the corporate entities, there's a corporate filing concept, the corporate entities that do not have more than 20% of property, payroll, or sales sourced to the United States. And you combine property, payroll, and sales and see if you get over that 20% metric. If you're not over that 20% metric, then that entity, that corporation is cut off from being included in the group that is subject to tax in California. So the concept is, that's the concept. There's a lot of texture to how you make that election and what it means and what gets excluded and what gets included and when something is included. That's beyond the scope of what we're going to talk about today, but that's the general concept. And it's kind of born out of this idea that even though you may have activity in a business in a corporate environment that could be subject to tax in a state, there are certain safeguards like a water's edge election that provide some limitation on what gets taxed. All right. So
Absolutely.
let's go to a polling question and see if everybody's paying attention.
Probably one of the more difficult polling questions we've ever put in the history of Andersen Tax 101 webinars. And the question is, California tax legislation follows the Canada-US Income Tax Treaty, true or false?
And I think we've probably beaten this to death because of my home state, and I'm sure we're going to get 100% in this. Although,
I suspect someone's going to mess with us.
I think somebody,
or maybe
I think somebody's just going to be funny.
Yeah, no, you don't know sometimes on this.
All right.
It really does surprise people when we talk, especially when they're trying to move to California and just trying to work in California, or even if they're just snowbirds spending some time in Palm Desert. It's the incidence taxation is quite something. So okay, so in our case there, almost 86% got it correct, in the sense that California is one of those 20 plus states that said, no, we're not going to follow the Canada-US Income Tax Treaty, and we set our own laws and you need to follow them. So the answer there is false.
I think the people that put true probably thought California should follow the U.S. tax treaty, and that maybe we feel is true, but the answer is no, California does not follow it.
Absolutely.
All right, so let's go on to some sourcing issues and kind of talk through, well, what does the source of income mean? Because we talk about Nexus. Nexus is your connection. We talk about the treaties. Treaties don't necessarily provide you the same level of protection. But what does it actually mean when work is being conducted in the U.S., either by an individual or by a business? So on the individual side, the income sourcing rules are relatively straightforward for an employee. It's where you work. So if you are subject to a tax in the United States, and if there is a tax in a state of the United States, the compensation paid for services in the state are subject to the tax in that state. So relatively straightforward. The time tracking mechanism and everything of how you actually do that can be kind of mucky, but that is the rule. There is a different rule for independent contractors. So in some states, independent contractors also follow the rule of it is where you work. And that is probably the majority rule across the country. However, many of the states have adopted market-based sourcing rules, which means it's not where you work, it is who you are performing the work for. For example, we had a screenwriter that was living in Arizona. This isn't a cross Canada, transaction or a cross international transaction, but it's illustrative. We had an individual that was working in Arizona for movie studios writing scripts and providing those scripts to California. Did none of his work in California. But the California Office of Tax Appeals found that because his work was benefiting a California-based company, that all of the income that he derived from that work was sourced to California and taxable in California, even though he never set foot in California. So that same rule, if you think about that from a cross-Canada situation, you could have the same situation where an independent contractor may be subject to a state tax merely because of who they are doing the work for, not where they are doing the work.
Well, and I think in this day and age of electronic commerce and remote work, and just finding the right people in the right situation, you're seeing this so much more often, where it's just that situation that they're physically doing the work in British Columbia, Alberta, somewhere in Canada, but it's for a U.S. customer, client, business, and you need to consider these things. We've had situations before, and particularly in your home state of Washington, where Washington is a state that's different. It generally does not have an income tax for individuals, but it does have tax. I mean, the tax is a revenue-based tax called business and occupations tax, based on the amount of revenue you generate either in or with the state of Washington. And so you can get into situations as a contractor, if you're providing services to a Washington state business, and if it reaches the certain thresholds, whether it's economic nexus or anything else, even though you never may have traveled to Seattle or Pullman, Washington, or wherever it is to conduct the services, you may still be subject to Washington state business and occupation tax, which is very different. It's a tax on revenue. It's a tax that's not creditable in Canada because it's not an income tax, but it could apply in those situations.
Right, that's right. And I'm glad you actually mentioned creditable as well. In the U.S., the U.S. states, when you're thinking about income, the states can only tax a sourced amount of income for what comes into the state, but there is no tax credit for the Canadian taxes that any individual would pay. So it is all an additional tax on top of the federal obligations. The federal Canada credit mechanism does not operate at the state level. So that's something to keep in mind as well. One more really quick thing on individuals, and I know there was a question in the chat, and I can't answer it quite so specifically. However, there's a question about retirement accounts, and when you move across border, you leave a state and you have a retirement account. The state rules are very specific about retirement accounts, and some, like California, have a very favorable rule that says if you have a retirement account but you've moved, and you're not a resident of the state anymore, then you're not subject to tax on that retirement account because you are no longer a resident of the state. So it is where you are living at the time that you receive the retirement account, that is the state or jurisdiction that would tax you. And if that happens to be Canada, there is no state that may impose a tax. And I think that is the general rule, but it is not the only rule. So you'd have to look on a state-by-state basis for retirement accounts. Okay, let's go on to business sourcing, because this is where it gets a bit tricky. If you go back into the history of the imposition of an income tax, and we'll talk about the income tax rules here for businesses, because the sales tax is generally wherever the good or the taxable service is delivered. But for income tax purposes, Going back to the history of the income tax in the US, income was generally derived from property, some kind of property. You had a store, you had a tugboat, you had a manufacturing operation, and that was all property driven. So going back in history, we would say, well, where was your property? And that's the proportion of the income that a state can tax. So if half of your property was in state A and half in state B, then state A and state B could get 50%. That has changed because of the way the economy has changed to a digital economy, a service economy, and what we have now, where the states now mostly drive that based on a sales factor. So now if half of your sales are in state A and half of your sales are in state B, then each state gets to tax 50%. If all of your property is in state A and all of your sales are in state B taxes 100%, state A taxes nothing. But that's not always the rule. I say mostly driven by the sales factor. Many states still retain a property factor. Many retain a payroll factor to look at where the humans are that are in the state. But most look at the sales factor either solely or weight the sales factor much more heavily. So you have to look at the composition of how income is sourced in the state. Now, hanging on sales factor, what does it mean that you have sales in a state? Well, tangible personal property is a bit easier. It goes by the destination. It generally is sales delivered or shipped to a customer in the state. There are some nuances around that when you ship to, say, a distribution warehouse and then the shipment goes on someplace else. So you ship to a distribution warehouse in Washington, but the product actually is ultimately destined for Las Vegas, Nevada. Then you have to look at, well, is the destination Washington or is the destination Nevada? So you have to look at the state by state rules. So it's not as simple as it seems, but it is a bit more straightforward than services or intangible property. When we get to services and intangible property, there are two primary rules that the states fall into. It is either where the work is being performed, kind of like the individual rules, or it is where the customer derives the benefit from the services or derives the use or benefit from the intangible property that is licensed. So that goes back almost to the independent contractor rules for individuals. So those somewhat align. And those are different on a state-by-state basis. So for example, we had a company in Canada that was selling an ERP system in the United States, users all over the United States. So you would send a bill to Texas, to a customer in Texas, but that customer in Texas would have users all over the country. So would the source of that sale be to Texas, where you're sending the bill, or would it actually be to where all of the customers are all over the United States? Or would it be back in Canada, because that is where the ERP system was developed and managed and maintained? Well, the states are all going to be different. For states that apply a market-based analysis, which is where are the users, where does the customer benefit, we do a lot of studies trying to figure out where those users are, either based on their IP address or based upon the exchange server through which the individuals access the ERP system to spread out where those users are and derive the appropriate percentage of the income in each of the states. So it can be an arduous analysis. It may be required in some states. It may be beneficial. If the bill is going to Texas, and then maybe not everything should be sourced to Texas, maybe it should be sourced other places, and you don't have to pay the Texas franchise tax on 100% of that sale.
Excellent.
So, Stephen, I think you've seen a lot of this with your clients as well.
Well, and certainly they're different concepts than we see just if you look at a domestic only situation, and so in Australia we're seeing more and more. Appreciate all of this, Eric. So we're on 10 minutes to the hour here, and we want to leave time for some questions. We want to make sure we got one more polling question. We got some hot topics here, and before this, Eric promised me you'd tell you the audience one of my favorite stories. But Eric, why don't you talk about some of the hot topics you're seeing?
Yeah, I'll do that, and then I'll get to that story, because this one, what the L is all about the local taxes, right? And that's the only point on this slide I wanted to make, is that as I talked about at the beginning, where there are over 50,000 taxing jurisdictions in the United States, don't forget about the locals. There's a lot of attention placed on the states, but big cities like Seattle and San Francisco, Los Angeles, New York, Chicago, Philadelphia all have some pretty high tax burdens on interstate, international activities, and the threshold for being subject to those taxes is fairly low. So just don't forget about that when we're doing these taxability assessments. The local taxes can be a pretty big bite, right? But let's go on to what you were just teeing up, Stephen, which is on other hot topics. Unitary combined reporting. I already mentioned the Water's Edge election, the worldwide Water's Edge. So unitary combined reporting means that when you have a group of related companies or a group of related business activities, that those need to all be put together into a single filing. And that is unique to the state reporting obligations, or you might have different corporations that could be in different constructions. So for U.S. federal income tax purposes, you can have a federal consolidated tax return that has its own requirements. On the state side, the requirements are different. So you can have different reporting obligations for a group of companies than you do for U.S. federal income tax purposes. On the individual side, where individual and business intersects, Stephen and I talk about many of these stories often, where we have individuals that like to expatriate from high tax states, and my state of California is no exception. If you think about the sourcing rules for individuals and what individuals are subject to in U.S. states, if you are a resident of a U.S. state like California, California taxes its citizens based upon all of the income earned in the state of California, earned everywhere. And then California will provide a credit for taxes to other states that are paid to other states. Well, the other state taxes are not Canada, and the other state taxes may be very low if you're talking about a no tax or a low tax state. So many individuals actually consider, and many do, and we have about 215 we're working with right now that have or are in the process of moving from California to a lower tax state prior to selling a business. Well, I had one individual that left the state of California with the papers in his hand for selling his business along with his business partners, with an 8-figure gain on the sale of that business, signed those papers when he landed in another state, and never came back to California. And the source of that income is, where was that individual living? Where did he reside? Or was he outside of California for other than a temporary reason at the time that transaction closed? And if you are outside of the state of California or a high tax state when the transaction closes, then the state of California or the other state that you left does not have the authority to impose a tax. So residency and the sale of a business and how that gets sourced at the individual, at the business level, that is a very hot topic, especially in my home state of California.
Absolutely. No, thank you for that. I think one of the important things there is to recognize those kinds of opportunities. And if someone's trying to, suggest to you, okay, well, how do I minimize my tax liability on this transaction? Anything we can find out beforehand to coach people through or to advise them is always valuable. And in your case, in a lot of situations, the ability to kind of leave that state and prove that you've left the state, I think makes it all the worthwhile. So thank you for that. We got one last polling question. I think this is probably a little more challenging. I might have hinted to the answer on this polling question, but the question is a true or false one, and it's: every one of the 50 states in the United States has an individual income tax. True or false? And we did talk a bit about the fact that it's different in the U.S. compared to Canada. Canada, in most provinces, we combine our federal and our provincial tax into kind of one tax return. one collection activity, even some of the provincial legislation kind of piggybacks on the Federal Income Tax Act. The U.S. is very different. Each state is its own different regime. And so the question there is, do they all have individual income taxes?
And this is a great question, because I think if you've ever had activity or roamed around the United States, you will see that there's a tax here, there's a tax there, seems to be a tax everywhere. And that would make you think that, yes, every single U.S. state of the United States has an individual income tax, including the District of Columbia, which also does impose an income tax. But the answer here is actually false. There are a handful of states, Washington, Texas, Florida, Wyoming, Tennessee, that do not levy a general income tax. So we don't have a tax. One thing that isn't on here is there are a lot of cities that actually do impose an individual income tax. So while we don't have every one of the 50 US states that has an individual income tax, we actually have more than 50 jurisdictions in the United States that impose an individual income tax.
Well, no, agreed. So thank you so much, Eric, for joining us today. We've got some time for questions here, and I'm going to ask our team here to go through the chats and go through the pre-questions, and feel free to pose some questions to Eric and I.
Yeah, I think there are a couple in here, and one was about the Texas example that I gave, which was, could you please explain the ERP from Canada that's billed to Texas but users all over the United States? How is this tax obligation determined? Is it based on where the service originated, or the percentage of users in each state? And this is one of those where I think this is it is a state by state determination of whether or not the state imposes it sources the income derived from that ERP license based on a market concept, which means users in the state, or if it is based on something else, which is based on where the customer is billed, or based upon some other rule. In Texas, it is based upon where the fair value of the services are received, if it is determined to be a service. If it is a license of software, it is where the legal domicile of the recipient is located. But that is different than the New York rule, which is where the users are located, or the California rule, which is where the company that is paying for the license benefits from that license, which then you have to go through, well, what does that mean? So there's no real clear answer. And you have to look at the nature of what it is that is being licensed, and then align that with the rules in each state where that license may be used.
Excellent. No, appreciate that. Were there some other questions? I'm just going to my team here. Were there some other questions there?
Yeah, there are a couple. Go ahead. I think you had a prompt.
Yeah, go ahead, Angie.
Yes, one of the questions is, what if when is a sale of service from Canada into the US, when and how would a taxpayer know if he or she should collect sales tax and or state income tax?
That's a great question. So there are a variety of states that levy income taxes on, sales taxes on services and on service activity, but it's a minority. It tends to be more on the sale of tangible personal property, but licensing of a platform or SaaS or an infrastructure as a service, those types of activities and digital goods are being more and more taxed in the United States by the US states. For those, we go back to the threshold. The standard rule is $100,000 to customers in a state. Or 200 transactions to unique customers, but the states vary in that. With income tax, it's a bit of more of a difficult question, because the states again have a nexus rule that may align with how much your activity is sourced to the state. So you may need to go to the income sourcing rule to determine whether the state deems that you have nexus and have an obligation in the first place. It seems a little backwards. Usually you look at the connection, you look at the obligation, and then you determine what the source is, but those two in this case go hand in hand. So for example, when you look in California, California has a different threshold for income tax. The threshold, it's indexed for inflation, but the threshold right now is a roughly $700,000 of income sourced to the state, or gross receipts sourced to California. So if services benefit customers in California greater than around $700,000, that means there is an income tax filing obligation, and there would be a requirement to determine what the amount of income is that is sourced to California.
And I think to put a point on that, I agree that how do you make that determination? And when we work with our clients on this, and if you've got those exposures, or if you've got those questions, you're welcome to contact myself, contact Eric. We can help you through these things. The first part I start with clients is I say, well, tell me about your activity. Summarize all of your U.S. activity, by revenue, by where your customer is. Tell us information of where you physically work, where were your work days, where did your staff work. Let's gather the information first, and then we can kind of sit down together and say, okay, which are the states that we've got the most exposure to? What are the rules in those states? What's the risk of income tax? What's the amount of liability? And then you got to go through a compliance decision to say, okay, are we going to comply with every single state? And would the cost exceed the benefits there? Or are we just going to kind of pick to say, okay, these are the 3 or 4 states that we have 90% of our activity in. These are the ones we'll focus on. We recognize that the other 10%, we might have some level of taxation, but it may be a situation where the cost to comply might exceed any tax you actually pay. So you got to go through kind of those analysis first before you make that determination.
That's right. And one of the questions was about penalties, and penalties are going to apply if the state finds you. But if you come forward, they generally will absolve you of penalties for voluntarily complying and going through that process. But Stephen, you're right. It is the equation of, well, if the penalty is going to be $100, but paying somebody or doing the compliance drill is going to exceed that, then eat the penalty, pay it, and move on.
Absolutely. I appreciate your time here. We're going to end there, just being at the top of the hour here. I want to thank Eric for joining us today. Really appreciate your time and all your great stories and some of this. Stay tuned for our next session, and that'll be. We have 2 sessions coming up later this month. We've got one of our biz tax sessions on transfer pricing. And then in the first of the month, we've got another biz tax section on cross-border employees. There's the QR code. If you got a cell phone, you know what to do. If you're not sure how to sign up, please contact us through the website or through other means. We'd love to have you on our future webinars. So thank you again, Eric, and thank you for your time today, everybody.
Great, and thank you for having me.